What if I told you the internet almost died before it even had a chance to grow up? Picture a planet slowly waking to the sound of a modem screeching into life, that tortured handshake that meant you were in. The late 1990s felt like standing at the lip of something enormous. Overnight fortunes, televised IPO celebrations, and the conviction that anything with a dot and a com was basically a unicorn waiting to be saddled. And then, in a few terrifying weeks and months after March 2000, that confident noise turned into a different sound entirely. The thud of paper plans hitting the floor. If you love long, messy tech origin stories, stick around, hit subscribe, because this one is equal parts carnival and cautionary tale. Back in 1995, the internet smelled like new carpet and possibility. You logged on at midnight to download a song or a picture, leaving the household phone line tied up like an emergency lane. Early portals, Netscape, AOL, Yahoo, acted like city squares for a suddenly global neighborhood. Browsers were our windows. Search was a novelty. Being online felt like being part of a revolution. The cultural shorthand was simple. If it was on the internet, it must be the future. Investors caught the fever. Venture capitalists and mutual funds didn't always ask hard questions about business models. They leaned on narrative. Growth was the prestige metric. Valuation, the number painted on a splashy pitch deck or flashed after an IPO, became shorthand for destiny. Burn rate, a dry finance term meaning how fast a company spends its cash, turned into a badge of honor. Spend now, capture market share later. If an idea could attract eyeballs, the rest could be filled in after the party. That party got very loud. By 1999, the spectacle had a soundtrack. Super Bowl ads for .coms with taglines and mascots. Companies that paid tens of millions for 10 seconds of national attention despite slim revenue. Teenagers were day trading in online forums. IPO windows opened and shimmered. Companies with no profits, sometimes with no clear path to profits, leapt into public markets and saw their stock prices soar. It wasn't just money. It was narrative momentum. The market rewarded the story. Tech was remaking everything, and the safest bet was to be on the train. Some of the ideas were brilliant. Many were not. Pets.com became the shorthand for a brand that had charisma, a sock puppet no less, but faced brutal realities. Shipping heavy pet food across long distances costs money. Margins matter. Webvan promised same-day grocery delivery, backed by gleaming fulfillment centers and a fantasy timeline of scale. Building a delivery logistics network is capital-intensive and notoriously unforgiving. eToys tried to be a toy emporium online, but during the holiday seasons that make or break retail, execution and supplier relationships mattered in ways a cheerful website could not erase. These companies were emblematic. Big visions paired with tiny unit economics, and a belief that market share could be bought before profits were proven. Let's pause on a couple of quick definitions, plain and simple. An IPO, initial public offering, is when a private company offers stock to the public. It's a liquidity event, a way to raise capital and let early investors cash out. Valuation is the market's price tag on a company. It's often forward-looking, sometimes wildly so. Burn rate is how quickly you're spending money. If you don't have enough runway, growth becomes a precarious and often impossible sprint. Then came March 10th, 2000. The Nasdaq Composite hit an all-time high that day, a pinnacle of the decade's fever. For a moment, the party felt immortal. But the market is an animal that loves narratives as much as people do, and narratives can be fragile. The same forces that raised expectations also make reversals violent. Over the following years, the Nasdaq would fall dramatically, a decline that wiped out enormous paper value and reshaped thousands of careers. Exact estimates of total market value lost vary depending on methodology. Some analyses point to truly staggering sums running into the trillions, while others calculate differently and give lower figures. But the human consequences were immediate and unmistakable. When the music stopped, it wasn't just numbers on a ticker. Payrolls were cut, entire teams dissolved, and many employees woke up to find their stock options worth less than the paper they were written on. Offices that had been the site of ping-pong tournaments and incessant whiteboard ideation emptied out. Investors who had been rewarded for bravado now faced the opposite problem: how to recover or accept losses. Headlines shifted from sexy IPO launches to bankruptcies and lawsuits. Banks tightened, credit dried up, and companies that had counted on round after round of cheap funding found themselves stranded. Why did so many companies fail? The short answer is multifaceted, a cocktail of irrational exuberance, poor unit economics, and the mechanics of financial markets. Hype can cover up operational weaknesses for a while, but growth paid for with unsustainable losses is vulnerable the moment expectations reset. Logistics-heavy businesses like Webvan discovered they had promised a level of physical infrastructure, warehouses, delivery fleets, inventory turns that was brutally expensive and required scale that came much later than investors wanted. Brands that focused on eyeballs rather than conversion or retention had to confront the fact that attention doesn't always buy loyalty, and loyalty is what pays the rent. But the other side of the crash story is the story of survival. Not every company that made it through did so because of luck alone. Some made decisive, often painful choices. Tight cost discipline, focus on core customers, and relentless improvement of the product. Amazon, for example, reoriented repeatedly. Bezos had long talked about the long game, but survival required more than rhetoric. The company doubled down on logistics, on obsessing over customer experience, and on building systems that could handle scale. eBay stuck to a clear product-market fit, enabling transactions between strangers in a way people trusted. Google, cultivated in relative quiet by Sergey Brin and Larry Page, concentrated on solving search and later monetization in a way that matched user intent to advertiser needs. AdWords turned search utility into a sustainable revenue engine without junking the user experience. The survivors shared common habits: an insistence on unit economics, an ability to pare back vanity projects, and a focus on what customers actually needed. They turned away from the glamour of the IPO spectacle to the grind of execution. Warehouses, algorithms, payment systems, shipping logistics, and reliable uptime. Those are the boring things that scale up into durable companies. One of the most important, least glamorous legacies of the crash was the physical and human infrastructure that remained. Data centers didn't evaporate. Neither did fiber optic cables or the thousands of servers under fluorescent lights. Engineers who had been laid off brought expertise to new ventures. The talent pool became a kind of seedbed. Venture dollars didn't disappear forever. They became more discerning. When the next generation of entrepreneurs arrived with mobile devices and social platforms, they inherited a network that was far more capable than the shiny, promise-heavy landscape of 1999. The Internet scaffolding, servers, transmission lines, data centers, and a more experienced developer class was a latent asset that would soon be leveraged in ways the bubble's cheerleaders hadn't fully imagined. Fast forward another chapter, and the Internet's shape shifted again. Platforms like Facebook, YouTube, and Twitter landed in a world where broadband and better tooling were becoming common. The smartphone, especially after the iPhone's arrival in 2007, changed everything. The Internet became personal, constant, and mobile. Suddenly, apps could assume a persistent connection and a location context. Notifications kept users returning. Cameras turned everyone into a potential content creator. The combination of improved infrastructure, smarter monetization strategies, and devices in people's pockets produced a new era of scale. But this time, with lessons learned etched into the DNA of both investors and builders. Companies now obsessed less with the spectacle of rapid headline growth and more with retention curves, lifetime value of customers, and unit economics that made scale viable. So was the internet ever in danger of literally disappearing? No, that would be too dramatic and frankly impossible in a globalizing world. What nearly collapsed was a market narrative and an entire investment ecosystem that had mistaken momentum for sustainability. The crash functioned as a severe pruning. It removed a lot of unsustainable enterprises, humbled some investors, and cleared space for builders who had focused on product, operations, and customer value. There's a human side to this pruning. For every success story we remember, there are people who lost jobs, savings, and confidence. The cultural memory of the dot-com crash includes those quieter, personal stories of careers diverted and ambitions reshaped. That cost should temper any tendency to romanticize the rebirth. Innovation often has casualties, and the most responsible storytelling recognizes that. What then is the lesson for today? First, hype can be a useful accelerator, but it's a terrible substitute for a repeatable, profitable unit model. Second, infrastructure matters, even if it's not photogenic in a Super Bowl ad. Servers, logistics, and engineering discipline are where durable advantage grows. Third, crises prune ecosystems, and the survivors are often those that focused on fundamentals during the hype, rather than those that chased the next headline. And for builders and investors now, in an era of faster product cycles and AI-powered narratives, remember the taboo of assuming headline momentum equals durable economics. Test assumptions with small bets. Know your burn rate and your runway. Build products people are willing to pay for, not products people are willing to talk about at parties. The day the internet nearly crashed forever was not a single black moment, but a season of disillusionment followed by patient reconstruction. That near death in market terms forced a reset, and from that reset came a sturdier, more pragmatic internet. One that could support global platforms, ubiquitous mobile access, and the entire infrastructure that underpins modern business and culture. The modem scream of the 1990s was replaced by a hum of data centers and the gentle ping of notifications. But underneath that new normal lay lessons learned the hard way. If this story landed for you, there are deeper dives we've done on how Amazon tightened its focus during those years and how Google's ad model evolved. Check out the next video on how Amazon survived the dot-com crash. And if you want more long-form tech history, subscribe. We'll bring you the messy, human, and surprising stories behind the headlines. In the end, the internet didn't die. It simply outgrew a fever. The crash was a brutal, clarifying test. Those who treated builders like magicians learned that magic is built, not announced. And what followed was not the end, but a reboot. Slow, painful at times, but ultimately more resilient, more useful, and more durable than the glittering illusions it replaced.